Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus, and this is the October 17 of 2022 edition of my quarterly premium plan webinar, where I will explain, this time a little different than usual. I'm really going to go over some current work that I have been working on. I think we're at a very critical juncture in a number of the markets. I'll show you why I think that. And I'll show you what the different plans are, different levels of service that I have here at Elliott Wave Plus. There's 4 different levels of service. Explain what those are, what's included with each one as I move through, and show you my current analysis on the S&P, bonds, U.S. dollar, gold, and then I'll leave plenty of time this evening for any questions as I go or at the end. It's okay. I'm here to let you know what we do here, and if you have any questions along the way about how I'm doing it or why, feel free to just jump in on the chat there and let me know. So put that away. The first thing I need to show you is my disclaimer. I'll bring it over. It's at my website, elliottwaveplus.com. And my disclaimer, as you look down through my website, there's a history on me and what I do with my systems. And there's 4 different levels of service. I'll go over that in a minute. My most current blog posts are here, and you can scroll through and look at some of the other ones recently. There's other ways to get to everything from these pull down menus up here. If you aren't a current subscriber, then you won't have as many tabs that show. But if you are a subscriber at some level, you'll have some additional tabs like I have up here, and you'll have access to those depending on what level of service you're subscribing to. But before we get started, I want to show you my terms of service or disclaimer. It's at my website all the time. All you have to do is scroll down to the bottom of any page there and click on that tab, just like I just did. And there's the terms of service and disclaimer. If I were to summarize this in one sentence, it would be, there's risk of loss in all trading. While I'm at the site, just very quickly, there's a page at my site called elliottwaveplus.com/pricing. Show this to you very quickly at the beginning of the webinar and show it to you again at the end of the webinar. This shows that on if you decide to subscribe, I have monthly plans and I have discounted annual plans. So you can click on the different ones there. And at the very start here, I want to show you that for $25 a month, this is called the trend plan. And that includes the current daily trend, a screenshot every night or 5 nights a week, the current trend on a daily basis on over 20 popular items. And it also includes my algo trade signals on 4 popular cryptos. It's Bitcoin, Litecoin, Ethereum, and Ripple. And then also included at the 25-month is my current Elliott Wave count on a weekly chart and on a daily chart. So that's all included on the $25 per month plan. It's our entry-level plan. The only Elliott Wave counts you get there are on Bitcoin. So and let's say I'm a subscriber and I'm logged in and I go to nightly reports. and we'll go to the daily trend reports. This is the only thing that the $25 a month plan gives you access to. So here is, this is tonight's report. So we're going to take a look at it. And what comes up is a whole bunch of trend charts, okay? So this, you just click on one, start with the Australian dollar, and you can see a trend screenshot. So the trend has been down since August 19 on the Australian dollar. And but now it is extreme, the trend is extremely overextended, and so you get this brown zone, this brown box when that occurs, and that is often a warning of an impending trend change. It's just gone so far, it's at very extreme levels. So and then these in the trend plan, you get these green buy zone boxes and pink or red sell zone boxes. You get an adaptive moving average, and you have an ATR volatility stop. So and that included in the trend plan is the Aussie USD CAD. Notice we're getting those same brown boxes that are warning of a trend change. As a matter of fact, you can see a divergence appearing on the ADX indicator down here. Crude oil, been trying to recently rally here just recently. We've had a pullback here for a few days. The current daily trend direction is down. That started just a day ago. Dow Jones Industrial Average, the trend has turned, the daily trend officially has turned to the upside using this system, and that occurred on October 13. And we're in a buy zone green box. We're above the adaptive moving average, and we're well above the ATR volatility stop. So those are positive developments on the Dow. We also have positive developments now on the euro. We're in a buy zone green box the last after today. GDX, the trend is very iffy at this time. It was up nicely, and then it pulled back, and now it closed the week just right even with those two moving averages, the ATR volatility stop and the adaptive moving average. So it's possible that it's trying to produce a trend change, but officially it hasn't quite done it yet. And so that shows you how to read those charts. These custom indicators that are programmed on these charts are very valuable and very simple to read. And if you don't have a sophisticated charting platform like I do, this may be of great benefit to you just to see these every 5 nights a week. So you can see what the daily trend is. There's gold, banking, KBE, all of a sudden, boom, looking like a new daily uptrend starting on October 13. NQ contract, NG, that's nat gas, is in a downtrend. NASDAQ is flirting with changing to an uptrend, but it's not quite yet. The Russell looks like it officially is on the verge of a trend change to the upside. Silver, a trend is still down, but it bottomed 3 days ago. S&P trend is officially still down, but it's moved up above the ATR volatility stop. So, and is, I think, on the verge of a trend change to the upside. Bonds, still the trend is down. U.S. dollar index, got a little trend change to the downside, and we have a new pink sell zone box. That's going to be important. And we're going to talk about all my wave counts and my cycle analysis, the sentiment, and the seasonality on all of these, on several of these, and the U.S. dollar index is going to be one of them. XLE trend is officially still up on a daily basis, and that's everything we cover in the trend plan. Other than, let me go back here a second, other than outside of cryptos. So if all you're interested in is trading cryptos, I suppose the $25 a month plan would do well for you. Here's a few screenshots. Here's what the screenshots you would get for the $25 a month plan. These are my algos. So we just had on Bitcoin, it exit a short position at the close today. There's my daily count on Bitcoin. As you can see, it's bullish, and included on the chart are some Hurst nominal model dates, some cycle work that I add to my wave counts on everything. And then this is bullish Bitcoin. That should be indicative. And it's, a matter of fact, the Hurst analysis is bullish on Bitcoin all the way through mid-April of 2023. Admittedly, we are only a couple of days past the bottom tick on this wave count, so it's quite early, but it is trying to work its way to the upside. And if you wanted to zoom in on these, you can hold down the control key and zoom in, move it around, and you can see we have most recently some up movement. This is what I've been expecting based on this wave count, which is been expecting a low, and a very important low, and it looks like possibly even a truncated fifth wave. This is very bullish on Bitcoin, in my opinion, at this juncture. There's several ways to trade Bitcoin. This is the full size contract. It also took a small profit on a most recent sell signal, and now it's flat and waiting for enough upward momentum to jump in on a potential long trade. Ethereum also recently exited a short position. That little green block right there, and I'll talk more about that, means exit the position. The big fat triangle means enter the position. So the sell signal came in here, the exit signal came in here. In this case, that red box back behind, very small, thin red box, was a small loser. These big green boxes on the algos, those were winning trades. The red boxes were losing trades. And then I keep on each, I just finished my optimization, quarterly optimization. Everything's been updated, optimized, and back tested for the last 3 years exactly on all my algos, and the stats that how the algo did. This is the full size of Bitcoin contract. Is too big for most people to trade, but it shows the size of the stops, the account size required, what the profit was over the 3-year period, how many winners, how many losers. And this is always important on my algos. What was the average size of the winner and what was the average size of the loser? And I programmed all my algos to have at least a 2-to-1, or I would say reward to risk ratio. So I'm looking for an average wins to be at least twice as the average losers. And that way, if you have kind of an even number of winners and losers, you still come out hugely in profit. And frankly, I've looked at back testing on my algos in umpteen number of ways. And this method that I use that looks to catch a momentum move and stick with it with an open objective until it loses momentum, it brings in big winners, but the losers are cut short because of the fixed stop or trailing stop. Some of them use trailing stop. So there's Ethereum, Litecoin. It's no longer in a short trade. It's exiting. All these are exiting their short trades now, which fits perfectly with my Elliott Wave count. This one right here had sell signal October 7. It exited in a slight loss. And this is probably the item that is the easiest to use if you want to be able to go long and short Bitcoin. Ripple. So Ripple has been actually quite bullish here lately, moving to the upside, and it's kind of diverged from Bitcoin. So that is a quick explanation of what you get with the basic trend plan. So going back to the pricing page, the next tier up at $70 a month, and that as you move up each tier includes everything in the prior tiers. So at the basic also level at 70 a month, it gets everything I just showed you on the trend reports and the algo signals and my wave counts on a weekly and daily chart on Bitcoin, but it also gets bi-weekly screenshots of dozens of items. So if I'm a basic plan subscriber, I'm going up here to screenshots. So I'm going to click on screenshots. Here's and the last edition of screenshots was yesterday on Sunday. I do them on Sundays and on Wednesdays. And you can see at before the market opened this week, there's many screenshots here. A number of bonds screenshots, a number of commodity screenshots: copper, crude oil, gold, natural gas, palladium, platinum, and silver. The cryptos are in there. At least my Bitcoin, Elliott Wave is in there. And then currencies: the Aussie, the U.S. dollar index, euro, pound, USD CAD, USD CHF, Swiss franc, and USD JPY. And then on sectors, the advanced decline line and a number of ETFs, ARKK, Baltic Dry Index, copper miners, transports, utilities, GDX, IBB, that's biotech, KBE, that is banking. Here's the daily chart on KBE, for instance, this weekend, and you can see I was quite bullish on KBE. And according to Hurst analysis, I was bullish on KBE next all the way into late December and eventually all the way into March. This is banking. And today we had, and Friday, we had a number of banks announce their earnings, and they were generally quite good. You know, with a rising rate environment, they should be making money hand over fist, and they are. Put to call ratio, silver miners, the VIX, real estate ETF, VIX sentiment. That was I have a sentiment conditions, a template that's incredibly valuable, and there was all kinds of signs on the current sentiment positioning of the commercials that they were looking bearish on the VIX. And as you can see, it looks like it's rolling over and hitting it down. It's in a red box. I'll explain more about our sentiment conditions screenshots in a minute, but the VIX is obviously very important to the stock market. When the VIX is moving down, stock market's moving up. XHB is home builders. XLE is large cap oil stocks ETF, and then XRT retail ETF. So that's in the sectors section. Stock indices around the globe. We have the Australian stock market, the German DAX, EEM, EWZ is Brazil, FTSE is UK, Hang Seng, Nifty 50, Nikkei, and the Canadian stock market coverage. This is on Sundays. There's a few less coverage items on Wednesday, but all the major, most popular tradable items are in the Wednesday screenshots as well. U.S. stock indices, Dow Jones Industrial Average, NASDAQ, Russell, semiconductors, S&P, and lots of charts of the big ones, like on S&P, we have quarterly, monthly, weekly charts, daily. We have an alternate on a weekly I show. And so, for instance, and then I usually have a 240-minute, and I've worked that back up. As you can see, this is a quick look at what I showed my subscribers this weekend. I'm bullish on the S&P right now, and I'll explain why that is as we move through the webinar. And then moving back to, and then finally, weekly trend charts. So weekly trend charts are, I originally created these for TSP retirement fund participants, and TSP funds are funds that specifically, it's a program specifically designed for U.S. government employees that allow them to choose among these different funds on where they want to put their savings. And those funds usually are something like an S&P ETF, a bond ETF, and a few others. So that is what is included with that EWP screenshot, or the basic level, which is $70 a month. I'm going to go back to pricing again, and then the next level is $100 a month. You get everything that I just showed you here and here, plus you get an invitation and a recording to a weekly webinar. So all the weekly webinars, and by the way, I'm quite different from I think almost every other Elliott Wave service. I leave about 2 years of history of screenshots, webinars, everything, all the work that I do for subscribers, so you can go back and look and see if I was accurate or not, what I was thinking at the time. And I think it's only fair. I wish everyone did that, but I know for many of my competitors, you can barely see any of their history at all. Maybe go back to last 1 or 2 editions of something, and that's it. I find that highly suspect, and I try to be more honest than that. And give full disclosure as to what I've been thinking with all my wave counts. And my webinars on Sunday are a big deal. They're usually 2.5 to 3 hours. I explain absolutely everything about what I am thinking at that time on dozens and dozens of charts, go into complete detail on what I'm thinking, and I'm going to do that here in a second after I explain our service. But for instance, this recording right here, good evening. I'm going to pause it. Is posted within about 3 hours after the webinar finishes. A straight up Zoom recording is posted first, and then within an hour or so after that, a indexed version of it is posted, where you can jump on the timeline to my coverage. Like if I'm interested in gold and silver, then boom, it'll jump on the timeline to my coverage of gold. And if that's your primary interest, or if you're interested in mining stocks, for instance, you go straight to my mining stocks on GDX and some individual stocks there. It's very easy to go back. You don't have to look at the whole 3 hours. If you don't want to, you can look at my specific coverage on any number of items from a on screen index. So the webinars are included. And then finally, the premium plan includes all of these, everything included in all these plans, plus you get a nightly algo report that includes screenshots of actual trade signals based on momentum algo, a proprietary momentum algo of mine, on about 24 popular items. And you also get sentiment condition screenshots. So if you were a premium plan subscriber, you'd be able to find this tab here under nightly reports, premium plan nightly algo reports. And this is the one from tonight. And so I'm going to click on that to view that. And by the way, there's a button on every edition of everything, all different screenshots for premium plan, trend shots, and EWP screenshots, where you can download the edition and hold them on your hard drive if you want. So the nightly report, it shows actual signals on about 2 different items, and there's a complete executive summary included every night on this. So this is the nightly algo signals for tonight, and they're color coded. So you can very quickly scroll through and see if there's any signals. Well, on emerging markets, it was on a sell signal from October 10, but tonight it's saying get out of that trade, okay? And then on bonds, there was a new sell signal tonight. You'll see in a minute why I don't agree that that's going to work. But these are all computer-based, no Elliott Wave or Hurst opinion here. It's strictly based on momentum. And my momentum algo knows that when there's a welling up of momentum enough to jump into a trade, it isn't always going to continue. And that's why it uses a protective stop, but sometimes it does. And then the algo will follow that breakout until it shows a distinct lack or loss of momentum. And that's the way that that one works. So there was a couple signals tonight is all, but it very quickly gives you a quick synopsis of my Elliott Wave count, what Hurst Cycle Analysis is thinking currently on the item, what the last signal there was on the item, and also what the sentiment condition is on the item. Speaking of sentiment conditions, and so this is all the algo signals that come through: Australian dollar, Canadian dollar, crude oil, DAX, Dow Jones Industrial Average, dust, which is 3 times bearish or 2 times bearish gold miners, EEM, emerging markets, euro, GDX, gold miners ETF, gold itself, KBE, the banking ETF, NASDAQ, nugget, the 3 times bearish gold miners, the dust, no, wait a minute, that's 3 times bullish gold miners. Let me correct that once again. It used to be 3 times. Now it's 2 times bullish gold miners. It's the opposite of dust that we looked at earlier. And then some ETFs that allow you to trade some of the major indices at a 2 times leverage. QID and QLD are for the NASDAQ. Then the Russell, SDS and SSO are 2 times bullish and 2 times bearish. The S&P, silver, the S&P itself, 2 times bullish and bearish Russell, U.S. dollar, and bonds on the ZB contract. So there's a lot of coverage items there, and those are automated trade signals. So we got a signal, I think it was on EEM. Let's see what that looks like. So tonight on EEM, we were on a sell signal from October 10, and it actually is suggesting exiting after at the open tomorrow morning because it's bouncing. Why is EEM bouncing? Well, I think I have a very good idea, and that's because the U.S. dollar index is rolling over and starting to move to the downside. That's going to be very beneficial for um, emerging market stocks in China. And there were several. Not only was there an exit signal here, little block to get out of the short trade, but there was this green stripe that was thrown up by this indicator down here. This is the some more custom programming I've done for premium plan subscribers, where I have an indicator called the money flow index versus the RSI. So the money flow index is essentially a volume weighted RSI, and it's represented by this blue line down here. The RSI is the black line. When the RSI is oversold, and that means when it's below 70, but the money flow indicator is above it, that throws up and rising, that throws up some stripes that are amazingly effective at calling bottoms and calling for like, for instance, right here is calling for a rally, which it did for a couple of weeks. And now it's saying, hey, we have an extreme situation here and it looks like a trend change. And then I also have on EEM, there's no daily sentiment index on this. So I've created an indicator called synthetic retail sentiment that kind of comes fairly close to estimating about what retail traders are thinking about this item right now and how they're positioned. They're coming off of an extreme bearish positioning, and very often at major trend changes, the retail traders are all over on one side of the boat and on the wrong side of the boat, and then the boat capsizes. So they're all very bearish here, and then that creates in this case, a short squeeze. And often these short squeezes occur at major trend changes. So we'll talk about that more as we move through the webinar. So there's what you get with the premium plan. You get the algo or the nightly report, you get the screenshots, and then there's one other thing you get that's extremely important, and that is sentiment. So let's take a look at sentiment on gold. This is a proprietary chart template that I have that uses several different indicators. The primary purpose for this, the sentiment condition screenshot, is to show subscribers the positioning of commercial traders versus retail traders. And very often at a major turn, you will have the commercials. In this case, in gold, that would be the producers. That would be the mining companies. So the mining companies have trading accounts, and the reason they do, and very large ones, is if they feel that the price of what they are producing is going to go down, then they hedge. And when they are hedged fully, that means they are very, very bearish. So you can see up here, these pink zones down here means that the commercials as a percent of open interest, that's a Larry Williams idea. He calls it the Wilco indicator, and showed how to program it in a book many, many years ago, and I programmed it into this template. It shows it is a fast acting commercials positioning indicator. The traditional indicators are just come from the COT report, and when the commercials are positioned very bearishly, like they were here, and that's in these pink zones, On a 6-month look back, that's what this one is. And that means that during this period in this pink box, commercials in gold were as short as they had been at any point in the last 6 months. And then when they, and then this indicator is the slowest acting of the three. And when there's a pink zone here, that means that the commercials are hedged, or in other words, they're bearish as much as they have been in the last year. So when you get on those three indicators all showing pink, that means the commercials are fully hedged. They are looking for downward price action. And if that occurs at the same time as retail is just off the chart bullish, as they were right here, this is the DSI, the Daily Sentiment Index. And they were, the retail traders were 95% of retail traders were bullish on this day. And if that wasn't enough, where the retail traders and the commercials were completely at opposites, the commercials are the ones that always are the smart traders, the smartest, and they generally win. The retail is, when they get up to like a 95%, it's unsustainable. And then one other thing that this sentiment conditions that screenshot, and our premium plan members get these 5 nights a week on over 20 items. When you get this brown zone, that means the ADX indicator is over 60. That means that the trend is way, way overextended. So this was a perfect storm of bearishness that occurred back here. And then I use a 3-period moving average of the DSI, and you notice that it changes from green to red to green to red. When it changes from green to red and all of those other conditions are in place, then that is a perfect bearish storm signal. And as you can see, that was really good. And then there was another one that came in here where the retail was at 87% bullishness, and the commercials were still all heavily hedged. Another bearish signal, boom. Then they switched up. The commercials were bullish and retail was back down to neutral. That produced a mild buying signal, not a full one. Why wouldn't it? The reason that wasn't a full buying, full bullish storm is because the retail wasn't deep enough yet. They weren't bearish enough yet. The point where we started, this started getting real interesting to the bullish side came in late September. That's where the commercials were all heavily long, they're green, and retail was just off of a 7 back here and a 10, a little bit of divergence there. And this was the first green candle after a series of red candles inside a thin green box. That means this indicator was green, and a thick and a medium walled box, which means that these two indicators were also green. In other words, the commercials were no longer really concerned enough about the price of gold. They didn't think it was going to continue down. They had taken off most of their hedges. So they were bullish at the same time as retail was very bearish, and that produced an incredible buying, perfect storm signal right there. Now, notice this little pullback we've gotten here recently. The fastest acting of the commercials indicator is saying, yeah, the commercials are looking at this as a pullback is all. But because they are still heavily long on a 6-month and a 12-month look back. So this is still a bullish chart. So that kind of shows you how to read my sentiment conditions chart. And you can see that I provide sentiment conditions charts every night for premium plan members on the euro, gold, NASDAQ, Russell, silver, S&P, U.S. dollar, and bonds. That is a lot of tremendous information that is provided. And also, when I do my monthly webinars, which are not monthly webinars. When I do my weekly webinars for Pro Plan members, I freely share that information for them once a week, the sentiment screenshots. So that is another huge benefit of, if you're sitting at these lower levels, there's so much more information is provided here, and then even more on a nightly basis here. So that explains my website, the different plans that we offer. If you have any trouble finding this particular page, which allows you to subscribe, it's at elliottwaveplus.com/pricing. And if you have never subscribed to any of my services before, if you would like to subscribe to one of my plans, I'd be happy to refund half of your first month back to you as soon as, but you need to email me about it. You need to email me. You could use the contact page on my site, or you can email me at sid@elliottwaveplus.com. So let's go to some live charts. So once again, my email address is sid@Elliott with 2 L's and 2 T's waveplus.com. You don't have to capitalize anything in here if you don't want. It doesn't matter, but it's sid@elliottwaveplus.com. If you're interested in getting half price on your first month as a subscriber, send me an email. We'll work that out. I'll see you as soon as your payment comes through, and I'll refund half right back to you. And then you can cancel at any time. If you do cancel mid-month, you will continue to receive all paid materials associated with your the duration of what you paid for until the end of your paid period, and then then it will end. So let me ask a question and see if I could get a few of you to answer using the chat. Of these 3 items, the 3 items I'm going to mention next, which is the most important to when it comes to timing the stock market? The Fed, bonds, or the U.S. dollar? And I'm talking about lately, over the last several months. Which of those 3 things are influencing the stock market the most in a very timely fashion? You can almost see them move tick to tick together. Anybody want to hazard a guess? Is it the Fed? Is it the U.S. dollar, or is it bonds? Anybody? Can you find the chat and throw in a guess? Anybody? TikTok. U.S. dollar. Well, let's find out. Let's find out. Let's try to use charts to prove which one. Mark also says dollar, and Allah something says dollar. And so let's take a peek really quick. First thing I want to show you is a chart I have on the S&P pages, and we're going to take a look at the Fed first. Take a look at the Fed first, and see if when the Fed makes a move, we're going to see if that is excellent information to wait for as far as timing the market or not. So hang on just a second while it brings up a chart. So while I am talking about this topic, I'll be showing you the S&P, bonds, and the U.S. dollar index. So I'm going to get to all 3 of those kind of at the same time here. I'm sorry, I have my charts are so involved, and I have so many of them on each page that it's takes a little while to move from page to page. So this is this entire year. This is the S&P for this entire year. So the question that we're going to look for is when the Fed makes a move, is that critical to timing the market? So there's the January 4 all-time high. And the Fed had been stuck at zero interest policy for the most part ever since COVID. We'll look back at the history and everything. But when the all-time high hit on January 4, the Fed was at 0.25 interest rate. So that's what they call zero interest rate policy. It's as low as they go. Now, you would think if you're going to see this kind of move right here, and this move down here was a move of 15%. That's no small move on the S&P. That initial kind of move down to this low was almost a 15% low. So you would think the Fed would have started raising right here. You know, if all you do is listen to financial propaganda TV, and they simplify everything, they really don't do anything complex. They bring people along to yap and talk, and almost all of them, the Fed is somewhere in every sentence that they speak, and about, you know, whether you should be doing some buying now or not. Well, you would think that right up in here, the Fed would have started tightening, but no, they didn't. They didn't start tightening until right here on March 16th. That was the first time they had tightened in like 2 years. We'll look back at the history in a second. And what did the market do? It went up. It was right in the middle of a trend, and it didn't even affect it. Then the next time they raised, they went from 5% to 1%, so they raised 50 basis points. Now, in that particular instance, the market went down. Then the next time they raised 0.75%, 75 basis points, and they did that right here. 1 day later, the market bottomed and rallied generally from mid-June all the way through mid-August. So you would have to say that the market was quite bullish after that raise. And then once again, on July 27, the Fed raised from 175 to 2.5, another 3/4 of a point raise on this candle. And then the market went up on that. Matter of fact, the market hardly really reacted to most of these. And then the next raise was from 2.5% to 3.25%. That's the last raise we've had. That was on September 21, and the market went down. But just like the market continued higher here, went up for a while and then came down. Can anyone tell me, is the Fed is waiting for Fed announcements and Fed changes? Is there anything tradable you can gain from that as far as the stock market lately? And the answer, obviously, is no. As a matter of fact, when you go back in time and you head way back here to the COVID crash, matter of fact, let's go back to the taper tantrum. The taper tantrum of the fourth quarter of 2018. So this was September 21 of 2018. The Fed had been raising for a while. They've been raising for some number of years as the market had continued to move higher. But finally, it appeared that when they raised to 2.75%, that was all the market could stand of it. And the market started to go down. And the Fed, in all of its wisdom, It was right in the middle of this plunge when it raised again to 3%. But the interesting thing about that is, yeah, the market didn't like these raises. But 1, 2, 3, 4 days later, after their last raise to 3% in December of 2016, December 26th, the market bottomed and it rallied all the way to the February of 2020 top. So it rallied from December of 2018 all the way pretty much to February of 2020. And you would think, oh, with this, if the market's going up, the Fed must have eased right back off after they raised to 3%, but they didn't. The interest rate stayed at 3% for quite a period of time. There's Trump demanded a large cut in July of 2019. They accommodated him with a 25 basis point cut. It had almost no effect on the market. So they did do a cut right here. And amazingly, the market went down 4 days after the cut, but then it moved sideways for a couple of months and then started moving to the upside. And then this is what happened during COVID. They remained at 3%, or actually 2.75% until this day right here, March 15, when they cut back to zero because of COVID. And then 1, 2, 3, 4, 5, 6 days later, the market bottomed and started heading up, and they stayed at that 25% for 2 years, for 2 full years after that. And the next time they raised was here. So what can I say? For the most part, especially lately, they've been, waiting for the Fed and trying to decide if you want to buy or sell stock. It's been a complete waste of time. It's not working. It's not a timing mechanism. Exactly right, Brian. The market leads the Fed, the bond market. So that's what I'm going to show you next. So let's look at bonds. And this is the bond market. And there's an overlay here of the S&P, that purple line. Now, back here, pre-COVID, the S&P and the bond market were moving pretty much together. S&P is moving up, bonds were moving up. And then COVID crash happened, and both of them crashed at the same time. And then the S&P, starting in March of 2020, rallied, but bonds topped in August of 2020. Now, there's something very interesting about this chart. I like this, using this BND ticker for bonds, because it shows you a very clear Elliott Wave pattern. 1, 2, 3, 4, 5. It has, from an Elliott Wave standpoint, it does appear that we have gotten a 5-wave down structure. Well, that's indicative of a new trend direction, and the trend direction is down now. But what happens after 5 waves down? You get a rebound. So how big of a rebound do you get? Well, you get at least a move back to the wave 4 of 1 lesser degree. That would be the first thing you would look at. And then the other things you would look at would be a Fibonacci retrace back in, maybe back to the 50 or even 61.8% retrace level. So on this chart, I've made a few notes. So the top on bonds was August 2020. Robert Prechter has done some excellent research on the history of Fed moves, when they start tightening, when they start cutting. And they generally, on average, over their entire history, have basically waited for the bond market to tell them what to do, and then they will adjust their rates to the bond market, natural bond market, and they'll do that on average at a 7-month lag. So bonds topped August of 2020. 7 months later was right here. Yes, bonds were moving down, and that would have been the perfect spot for the Fed to start hiking, because bonds were going down. In other words, yields were going up. So they needed to hike in order to keep the interbank overnight loan rate somewhat similar to the current bond market. But in this case, they didn't do it. They didn't do it here. As a matter of fact, they waited all the way to mid-March of this year to start hiking. Well, this was a grand disservice. Now, the reason why they didn't hike there is they were still afraid of COVID. But the fact of the matter is, they laid down on the job, and they didn't get it done. And you'll notice that that the stock market, as long as they were staying at zero interest, it kept going up, and it only started reacting to the downside in January of this year, not at the beginning of the move down in bonds, but at the beginning of the wave 3 of 3. So 1, 2, 1, 2. So this was the beginning of wave 3 of 3. That is when the S&P started its correction that we're still in. And the Fed didn't raise until March 16th. So the Fed actually, it's amazing to hear on television them talk about, well, the Fed still need to raise, they still need to raise, and so we can't do anything. Really? They're on a 7-month lag normally. And in this case, they lagged something like, before they actually reacted to the new downtrend in bonds. They waited from August 2020 to March. So September, October, November, December, January, March. So the year and a half. They waited a whole year and a half. So what the Fed is actually doing right now is they're playing catch-up ball as fast as they can without stunning the market. They screwed up, and they aren't fighting inflation or trying to create a soft landing. They are just simply trying to catch up to this chart. But they can't admit that. They can't admit, oh, well, we're way behind, so we got to catch up, and that's the reason we're raising. So the reason they give is that they're fighting inflation. Well, what if this chart, but what if we end this fifth wave and start moving to the upside? If bonds start moving to the upside, the market's going to like it. But the Fed probably won't react to it until May of 2023, which is 7 months after the bond rally starts, if it bottoms right now, which there's some signs of. Notice the bullish divergence on this weekly chart. Also, this indicator has become very important to me. The RSI is below 70, it's oversold, but the money flow indicator is above it. That's why I threw up this giant green stripe. Matter of fact, this dark green stripe, look at the 3 times it showed it. At the bottom of wave 3 of 3, and then at the bottom of the big wave 3, and now at the bottom of the wave 5. Bullish divergence. If the bond market has a bottom, it's in a bottoming process right now, in my opinion. And that cycle analysis agrees. As a matter of fact, we're probably going to see a 2-year rally in bonds in 3 waves, possibly all the way back up to the 0.618, and I'll show that to you in a minute. So things are looking like a turn is relatively imminent on bonds. The Fed is so behind, they have become passe. It doesn't, what they do is they still have to catch up, and they're not driving the market. It's obvious. There's no timing that you can gain from what they do. So we've excluded the Fed. So let's take a look at and we can see that bonds, if bonds starts to move up and after 5 waves down, that means interest rates will start coming down. Most assuredly, the stock market will like it, and so will commodities. But while we're on this set of pages, let's look at the U.S. dollar index. On the U.S. dollar index, I've also overlaid that purple line, which is the S&P, but I've inverted it. So this was January of this year, the first few days of the year, right here, when the S&P bottomed, and S&P has been moving down ever since, but I've inverted it to show how highly correlated the stock market is to the U.S. dollar lately. Notice that stock market was moving up at the same time as the U.S. dollar was moving up, but around June of 2021, the U.S. dollar started moving, screaming to the upside. In my opinion, what we've been seeing is a terminal thrust out of a triangle. You can see that here, and I'll show it to you on a longer chart here in a minute. But notice that the dollar was able to kind of get some momentum going, but when at some point it became a problem for the U.S. stock market. And so the U.S. stock market has moved up here. It looks like, I'm sorry, moved down. It looks like in 5 waves there, but there's a problem with that. There's an overlap. So it's not a clean 5 waves structure to the downside in the S&P. We'll look at that in a minute. It's got several overlaps in it, really, but it had a very important overlap in it where the supposed wave 4 moved down into the price territory, wave 1. But notice the U.S. dollar has been very aggressively screaming to the upside, and the stock, it's been very bearish for the stock market. It appears to me that of the 3 potential correlations, this is the strongest. That the U.S. dollar has presented a problem for the stock market, and it's going to continue to be a problem unless it stops going up. So to summarize, the U.S. dollar appears to be the linchpin for just about everything right now. And I've been talking about this on my webinars for weeks and months on end. And it really does seem to be in control of the market, not the Fed. And the bonds secondarily, yeah, they're important too, but it appears that the tightest correlation is the dollar. So let's, I promised you I would look at several things. Let's look at the S&P first. And I'm going to do it in a manner that is very similar to the way I do it in my weekly webinars. We're going to look at Elliott Wave. We're going to look at Hurst Cycles. We're going to marry those 2 together. I'll even show you Sentient Trader software and the Hurst Cycle analysis there.